In the first week of November 2025, the stock market did something absolutely wild. It soared to a record high. And then, almost in the next breath, it felt like the floor just vanished. We're talking about a shift from pure euphoria to outright panic in what felt like the blink of an eye. So, let's get into it and break down this week of pure market chaos.
So, you gotta ask, right? What on earth happened? How does a market that looks completely unstoppable suddenly slam on the brakes and go into reverse so violently? This isn't just a story about numbers on a screen, it's really a mystery about what happens when a super powerful narrative just shatters.
Okay, so our story really kicks into high gear on Tuesday, November 4th. The day started with this chill in the air, as the CEOs of Morgan Stanley and Goldman Sachs, you can't get more insider than that, went public with some pretty stark warnings. They saw the market, especially AI stocks, as dangerously overvalued, and they said so. That's basically the captain of the ship getting on the loudspeaker and announcing there are icebergs dead ahead.
And this is where things just they get weird. Take Palantir, for example. They had a great earnings report, they beat expectations, and they even told investors the future looked even brighter. Now, in any normal, sane market, that stock would be taking off like a rocket. But not on this day. Nope, it plunged nearly 9%. This was the market screaming that it didn't care about good news anymore, it was terrified of high prices.
And look, this pain wasn't just in a few flashy tech stocks. On that very same day, over 300 stocks in the S&P 500, that's more than 60% of the entire index, closed in the red. So while the main index numbers might have looked okay at a glance, underneath the surface, the whole foundation was starting to crumble.
Now, to really understand the sheer whiplash of it all, we have to rewind the clock just a couple of days, because before the panic set in, there was a party. A huge one. The mood on Wall Street wasn't just optimistic, it was absolutely euphoric.
Just look at this rapid-fire succession of good news. On Halloween, you had Amazon and Apple delivering incredible earnings. Then on Sunday, November 2nd, the White House releases details of a trade truce with China, which lifted this huge cloud of uncertainty. And the result? The market shot up to an all-time high, closing out this historic 6-month winning streak.
But here's the thing. Even while the champagne was flowing, there were some serious red flags. A lot of analysts were pointing out that this was a dangerously narrow rally, meaning just a tiny handful of tech giants were doing all the heavy lifting. And after the best May to October run in over 70 years, with the market up nearly 23%, a lot of people were warning that all the good news was already priced in.
So, with the market already fragile and way overextended, a perfect storm started to gather. Three powerful forces all came together at the exact same time to turn that euphoria into fear. First up, the AI reality check.
So get this, the very stocks that had powered the entire rally in 2025 suddenly became the biggest victims. NVIDIA, the undisputed king of AI, lost nearly 10% of its value in a single week. Meta, Microsoft, all the big names, they all got hit hard. The market's favorite story was suddenly turning into a horror show.
And here's a big reason why all that skepticism started to bubble up. People started talking about something called circular AI deals. The basic idea was that these tech giants were just spending billions of dollars on each other's AI services, which created this illusion of massive organic demand. The big question became, is this real sustainable growth, or is it just an echo chamber of big tech spending?
And just like that, the AI bubble narrative was everywhere. And it wasn't just a few bears growling anymore. The IMF and the Bank of England raised official red flags. A bombshell MIT report came out saying that a staggering 95% of corporate AI projects weren't delivering any real return on investment. And then, the cherry on top. Michael Burry, the investor made famous by The Big Short, revealed he was betting against the AI darlings. The story had officially completely flipped.
So that was element number one of our perfect storm. The second element was just pure political chaos. Right as investors were getting nervous about tech, Washington, D.C. decided to throw a massive wrench into the gears of the economy.
The U.S. government shutdown just dragged on and on for over 36 days. It set a new, and pretty painful, record for the longest in American history. And this wasn't just a political headline, it had very, very real economic consequences.
And that real-world impact was huge. Goldman Sachs did the math, and they estimated the shutdown would slash Q4 GDP growth by a whopping 1.15 percentage points. That is a massive hit to the economy, coming at the worst possible time, when the market was already on shaky ground.
But for investors, and especially for the Federal Reserve, the most terrifying part was this: a complete data blackout. The government agencies that publish all the critical economic reports, the monthly jobs numbers, inflation data, they were all closed. Dark. Everyone was suddenly flying blind, with no instruments to tell them if the economy was speeding up or falling into a nosedive.
And you can see exactly how that blindness shook investor confidence. The market had been coasting along, assuming that a December interest rate cut was a sure thing, like a 90% probability was priced in. But with no data and a clearly nervous Fed chair, those odds just plummeted to 69%. The safety net investors thought they had was suddenly looking a lot less certain.
So the third and final piece of this storm is that the problems in the U.S. did not stay in the U.S. The fear was contagious, and it spread through global markets like wildfire.
I mean, just look at this sea of red. While the Nasdaq led the way down here, losing over 3%, Japan's Nikkei index got hammered even harder, dropping a full 5% for the week. European markets also followed suit. It was a crystal clear signal that when the AI-fueled U.S. tech market sneezes, the entire world catches a cold.
So what can we learn from this week of pure chaos? Well, first, hype is fragile. When a rally is built on one single, narrow idea, it can fall apart with incredible speed. Second, narratives are everything. The market wasn't really trading on earnings reports. It was trading on the story. And when that story shifted from AI boom to AI bubble, the whole game changed. And finally, you see how interconnected risks are. A tech sell-off alone is bad. A government shutdown alone is bad. But you put them together, you get a perfect storm.
Which leaves us with the ultimate question, doesn't it? In a market that seems to be more and more driven by these powerful, exciting, and let's be honest, sometimes irrational narratives, how can anyone truly know when the hype is about to end and that painful reality check is about to begin?